Hey everyone, and welcome back to the Venture Summit. This is Great Quarter Guys, the show where the lines between freight, finance, and tech are none. I'm your host, Andrew Cox. We are live from HQ2 here in Chattanooga, Tennessee. I'm a research analyst here at FreightWaves. With me, I have a fellow research analyst and member of the Freight Intel Group, Mr. Seth Holm. Thanks for joining me today, Seth.
Thanks, Andrew. Good to be here.
We're going to have another guest here after a commercial break in a few minutes. That's going to be Mr. Thiago Olson. He is the managing director of Engage Ventures in Atlanta, a very unique VC group that brings together a lot of Fortune 500 companies as well as some university researchers at Georgia Tech and fosters this ecosystem of innovation really focused on the Southeast and Atlanta especially. So that's going to be a great conversation after the break. But before we get there, we're going to run through our gauntlet of interest, our kind of ode to highly questionable see or no. This is going to be you care or nah. I'm going to propose an idea or a topic or maybe an event to Seth, and he and I are going to give the reasons for why we care or not. The first one is a big one. This is the Ant Group IPO. This is the fintech company in China, a subsidiary of Alibaba, was supposed to be the biggest IPO ever. I mean, just they were supposed to raise $34.4 billion in concurrent IPOs in Hong Kong and Shanghai, but 2 days before it goes live, it gets pulled off the books. Seth, you care or not?
I do care, and this one's fascinating to me. Reading about this, I mean, it's everything you want in a news story. It's completely sketchy, and it's an enormous company. We were kind of talking about offline how big this company is. So, Ant Financial, in industry terms, in the payments industry, there's GPV, which is gross payment volume. They do $17 trillion a year. In gross payment volume, which basically, I mean, just to put that in context, the U.S. GDP is 21 trillion, and they're about the same size as the EU's GDP.
So walk me through that math. We did it in a kind of a back of an envelope math earlier. How many, they've got 1 billion people roughly using the app. What does that equate to on a yearly basis?
Well, so 17 trillion divided by a billion is about $17,000 a year in average payment volume for each one of the users. And, we were kind of talking about, what is the average income for someone in China? I think it's for an individual in the U.S. It's what, like 35,000?
Yeah, I think household it's gotten up to like 50 or 55,
50 or 60.
Yeah.
So, I mean, on the individual level, I would think that would base the math that we worked out in our head would mean that basically 2 out of every 3 people in China would have to be spending 100% of their income through one app.
Yeah, and that seems crazy because, no one app has that kind of market dominance in the U.S., but Alipay, they do everything from micro-lending between a financial group and people, micro-payments between people, from business to business. I mean, every financial transaction you can imagine, they have like 80% of the market share of those financial transactions. So once you think about it, it's like maybe that 17 trillion is actually a number that you can realistically get to, which it's just nuts. It's basically the size of the European Union annual GDP. But this is, I definitely care about this one as well. I'm an Alibaba holder. Alibaba owns 30% of this, so you saw Alibaba trade off in a major way yesterday, down like 10%
right.
Or something. This is supposed to be the biggest IPO ever, even bigger than Saudi Aramco last year, and it just seems to me that this could have gotten done earlier, right? Like they waited till the 11th hour to get this done, and we're not completely clear on what the reasons were. We know there's been some sort of regulatory changes that are going to change the financial outlook for Ant, so they haven't disclosed that to investors, so that's why they pulled it.
Right, and I mean, I think one thing, this is a little bit symbolic in terms of it. No one is above the law in China. I mean, if you think about Jack Ma, he's probably the wealthiest guy and private individual in China. If he's not the wealthiest, he's probably top of a handful. Yep. And the Wall Street Journal article that we read made it seem like he made some comments about the regulatory landscape that were basically directly opposite to one of the head guys in the Chinese government had laid out just before him at a big conference in Shanghai. And after that, there was a closed door. He was called into a closed door meeting, and the IPO was pulled, a day or two later.
The last thing I'm going to say about this before we move on to our next topic is it was a big deal for Ant to decide that they weren't going to do an American IPO. They weren't going to have an American listing. And this makes me think, maybe some of those up-and-coming, those unicorns in China, maybe they rethink. I thought many would follow that path, that they would go for Hong Kong or Shanghai, but maybe with this regulatory problems, they might start looking towards the U.S. or European as an option again.
Yeah, I mean, I do think it's a big blow to both the Hong Kong and the Shanghai, what is it, the Star Exchange?
Yes.
It's a setback for them because this was a really sort of big milestone and iconic IPO. Would have been the biggest the world's ever seen, and they had to return the money to investors. So I think it's a very sort of stark sign of the investment risk that you take whenever you put money in China. So even if you're Jack Ma, your IPO can be squashed immediately if you do anything to upset the government. So there are risks out there.
Definitely. Some big risks for the next companies that we're going to talk about. These are two mall REITs, so real estate investment trusts. Two separate ones filed for bankruptcy in the same week. Just last week, this is CBL Associates and the Pennsylvania REIT. They both filed for Chapter 11. Seth, you care or know about this?
I don't care in the sense that I'm not surprised at all by this. These are landlords for B and C malls, as opposed to Simon Property, which does a lot of the A malls. And so I'm not surprised in terms of the fundamental deterioration in just sort of the mall business. It doesn't surprise me at all. I do care in the sense that CBL is a local company here in Chattanooga. Yep. And so although they aren't going into liquidation or anything, they're going to be restructured, but it probably does mean some job loss or a little bit of a hit to the local economy. As for the Pennsylvania REIT, I don't know much about them.
Yeah, other than they're the largest real estate owner in Philadelphia, that's about all I know about them, and that they operate the second and third tier malls. Some stark data here from CoreSite Research. They say that malls rank as the most avoided public space by consumers going into the holiday season. 55% of consumers say they're going to be avoiding malls.
I'm glad you brought that up because when I was reading the script in that article, I was pretty surprised by that. I mean, I don't know where I would have put that just in my head in terms of on the most avoided places, but it wouldn't have been a mall because malls you have a lot of space to operate, especially if if there's not a lot of traffic in the mall, you can definitely social distance if it's not packed in there. And,
you can
do your shopping.
Yeah, do the limit store quality.
It didn't strike me, in other words, as being that dangerous. Now I can understand being on a cruise ship where you're packed in like sardines on the with nowhere to go. That would have struck me or an airplane even. But I was a little bit surprised by mall being number one.
All right, so we got about 2.5 minutes here before our break. Let's get to this very cool company out of the UK, which I had just heard about a couple weeks ago. You've heard about them for a few years, but this is a British online supermarket. So I didn't say British online grocery delivery. I said literally a online supermarket. It's a fully automated warehouse using these incredible autonomous robots. And I want to show you a video. I've got a quick clip here from the Ocado supermarket that kind of gives you an idea, because it's really difficult to understand what these are, but there's thousands of these little bots that can pick a 50 grocery item shopping list in less than 5 minutes, and then it's on a truck to be delivered last mile to the homes. So it's remarkable. And the news we're bringing up here is that company, Ocado, just made 2 major acquisitions in the U.S. over the past week. They're 2 robotics companies. It's a San Francisco-based Kindred System. They paid over $250 million for that one, and then also Las Vegas firm Haddington Dynamics. So $287 million altogether. In this, you care or not, Seth?
I do care. I've followed this company, not closely, but for a couple of years. Kroger made a big investment in this company, I think, as they look to expand their operations in the U.S. I think when you think about online grocery, you're trying to take a lot of the overhead out of the brick and mortar retail, right? And so you need this robotic, efficient operations. That is a very cool video. It reminds me of like the robots in an Amazon fulfillment center.
Yep.
The way they kind of go around. One thing that struck me is, I don't know, is it required that a human, like sort of those totes that it goes in the hive, does a human have to load that?
No,
and reload that?
That's one of the biggest things here that the CEO said that was one of the reasons that they were doing these acquisitions, is that they're just looking for more robotics power, more engineering power, and they're trying to solve one of the hardest problems in robotics, and that is picking and sorting of groceries. There's such a vast disparity between the weights and the sizes and the shapes of things that have to get put into that you go to the grocery store for. So it's a remarkably difficult problem they're trying to solve. But I love this business because it's a growing market. We know that we're looking for these new normal, what it's going to be like after COVID, and we know that we think online grocery is one that's here to stay. And we've seen that 3x the spending on online grocery since pre-COVID. We've got about 2 minutes of messages for you. We'll be right back with Thiago Olson from Engage Ventures. Y'all stick with us. Don't go anywhere. Welcome back, everyone. So on the line, we have Thiago Olson, the managing director of Engage Ventures. And I'm going to open up the question to you, Thiago. Engage is not your typical VC, right? You've got this kind of unique model where you bring together Fortune 500 companies as well as some university research to give kind of a more robust offering to your startups. Can you tell us a little bit about your model and how it separates you from other VCs?
Yeah, so thanks for having me, guys. Engage is unique, as you said. I guess the way to think about it is we have 11 different Fortune 500 LPs or investors or corporate partners, and we kind of pull that capital and turn around and invest in emerging high growth tech startups. So, our thesis there is really investing in companies we think we can add a whole lot of value to through kind of the corporate partners. In many cases, the CEO of each of the corporate partners is on our board, and we've kind of taken a top-down approach to really helping them kind of work that muscle of working with startups where, if you think about Fortune 500 and startups, it can be a bit of oil and water sometimes. So that's Engage in a nutshell. We're based right here in Atlanta.
So, Thiago, we heard earlier, everybody watching this morning saw the Steve Case keynote. He referred a lot to the tours that he takes, the Rise for the Rest tours, and he talked about how people would question him and think, can you really find entrepreneurs in these middle of America cities like Chattanooga or Grand Rapids, Michigan? Can you really find entrepreneurs that are looking to grow big companies? And he resoundingly said yes. And you guys are really focused on the Southeast, and in particular Atlanta. I think like 70% of your initial investments were based in companies in the Southeast. Tell us a little bit why the Southeast, why Atlanta, and why are you attempting to be so hyper localized here in the South?
Yeah, so we have investments across the country, Silicon Valley, internationally, and everything. But you're right. There's this concentration of portfolio companies in the Southeast, and I agree with Steve there. I think there's an outsized opportunity for companies to be founded close to their end customer. So a big focus for us is supply chain and a lot of enterprise technology, and there's it's the third highest concentration of Fortune 500s right here in Atlanta. So what better place to kind of come figure out your go-to-market in rapid fire? So what we like to do is we have each of our corporate partners is kind of focused on a different vertical or segment, from wealth management with Invesco and financial services with Goldman Sachs to Home Depot and UPS. Kind of spreads the spectrum, so you can really start prioritizing what we call your go-to-market, which it's one of the biggest issues we run into with entrepreneurs. Is a lot of the best technology has so many opportunities, but what do you prioritize? What do you target first, or how do you get to market?
Okay. Hey, Thiago, so you guys at Engage, you invest mostly in early stage. Either I've seen a lot of your investments have been accelerator or seed stages, or up to early stage A. Is that a factor of just the amount of capital, or what are the other reasons that you want to get in on the ground level? Is that something that is requested from the Fortune 500 companies you work with?
So we, in many ways, are stage agnostic. We're not afraid of going early and getting involved. Was just a couple of founders, but on the other end of the spectrum, have made investments in companies kind of 70, 80 folks, kind of the Series B stage. But that sweet spot is kind of, let's say, seed to Series A, and what we like to look for is an outsized opportunity to add value and to help with that go-to-market. So for some, it is they have a repeatable model, they have a large team, and they need to rapidly try to prioritize different kind of verticals and segments that we can help them kind of rapidly learn and get answers to, all the way to earlier stage companies that could really benefit from. They have maybe a wider sort of a solution and can try to go to market, at the same time as kind of forming a little bit of that product market fit. So it really kind of just depends on the particular company and how we can add value, and that means we'll get involved in a whole bunch of different stages.
Cool. Thanks, Tiago. Let's talk about the funding process for a moment. So, first off, how do you guys go about finding opportunities, and vice versa? How would a startup get in front of you?
Yeah, so we actually track this, and there's founders can always reach out to me or other team members directly, Thiago at engage.vc. But like all things, it's best to kind of try to find someone who can a warm intro. But in general, a lot of the companies that we're running into are kind of sourced from other portfolio founders. Our corporate partners. And a big piece of what we're starting to do now is really develop more sophisticated thesis on the space and be proactive about reaching out to entrepreneurs that we really kind of see headed in the right direction and see if we can be good partners there.
Thiago, how do you determine how much capital your portfolio companies are going to need to invest and grow and reach their goals?
We like to break it down and take a milestone approach. So instead of some finger in the wind stuff like, hey, I'm going to raise X amount of capital and I have 18 months runway, we think about it much differently. That the growth path isn't just this linear line. It can feel like it as a founder because every day you're progressing a little bit more, but it really comes as a stair step. So those stair steps are around milestones, primarily around moments in time where you're pulling risk off the table. So if there was a question around, let's say a company is shifting from founder-led sales where the founder or CEO is selling, kind of leading the majority of the sales effort, to kind of a repeatable process with the sales team. Once those metrics are there to support it and everything, risk is pulled off, and that would be kind of one of those stair steps. So milestones-based approach is how we do it in short.
Gotcha. Also, Thiago, in our research, it looks like to Andrew and I that 2020, you've had a little bit of a deal slowdown. It looks like you've done about 9 deals year to date, and that compares to 23 in 2019 and 18 in 2018. We were just wondering, has that slowdown in the deal flow, has that been, COVID related? Has that been a lack of opportunities, not attractive valuations, or does that mean that there's a lot of dry powder out there for deals in the future?
Well, I think generally in the market, there's a whole lot of dry powder, which is why you've seen stuff kind of speed up here on the back end of the year. For us, that's less COVID related and more about, we're in between 2 funds. So we're now on Engage Fund 2 and investing out of that vehicle. So you should see that tick up real quick here. Okay. So we probably make 15 to 16 new investments every single year and a whole bunch of kind of follow-ons there. So, at this point, we're the most kind of active investor in the Southeast and plan to continue that.
Thiago, I know you can't get into too many details, but just off the air, you were talking about opportunities you were looking into FreightTech, supply chain, and logistics. What are you looking for? What's appetizing to you right now, and has that changed because of COVID?
Yeah, it's a really interesting time, I'd say, for startups and investors in supply chain. So I think the McKinsey quote I saw or some of the research is, there's been 10 years of e-commerce growth in a 3, 4, 5 month period. And that spells great kind of opportunity and the right swing for startups tackling problems in this space. So for us, if I level back and I look at the opportunities, there's automation, and robotics across the supply chain that can help these kind of partners, keep up with the rapid kind of swings in growth in e-commerce. In general, like one of the stats that's just really astounded me is digging in trucking dwell times. It always gets passed off if I'm the shipper at the dock, it's the trucking company or the carrier's problem. But if you really break it down and think about things from a macro perspective, you have potentially north of 25% of all of the capacity utilization time just wasted sitting around. So what are the technologies, whether it's automation, robotics, software-based approaches that can help try to streamline that and make distribution yards and loading docks a lot more efficient. Same thing, data is kind of a really interesting kind of swing here, where everyone talks about visibility and end-to-end supply chain data and everything, but in reality, when you dig in, you have all of these siloed buckets. There's data around trucking, and that's separate from warehousing, and all the different buckets they're going all the way back to manufacturing. So there's this opportunity to really start looking a lot more end to end and just providing a ton more value there.
We got about 3 minutes left here, Thiago. I thought I'd ask you a high-level sort of investing question here. So we know that founders and venture capital are tremendously important. So when you're out there looking at potential new investments, what do you look for in a founder, and what personality attributes do you like to look for, and then how do you identify them, and when do you know that this particular founder may be what you're looking for?
Yeah, I guess two things. If I'm investing, if I'm a tech investor, I'm looking for some sort of tech, right? That's meaningfully different, that can provide some real value there. But when it comes to the founder, many times that tech doesn't need to be the differentiator, and that founder is more transparent and kind of the more they talk to the actual go-to-market or the actual play, the better. But I'd say the number one kind of thing that I'm looking for in a founder is what I'd call magnetism. And it's that ability to storytell and attract really talented people. And I found that capital just tends to kind of follow that, because if I'm looking at a company and I see someone that has unlimited optionality to go work anywhere or start something, and they've decided to come join you as a founder in starting a company, I mean, and you start seeing more of that, that tells me everything I need to know. Like, that person can, build something really big. And I think building something really big requires just getting amazing people together. And that requires a special sort of person. Otherwise, everything's fragmented.
Makes a lot of sense.
Yeah, that makes a lot of sense, Thiago. I gotta cut us short here, Thiago. Unfortunately, we'll have you back on shortly, I'm sure, here on Great Quarter, guys. I want to thank you for your time today. This has been wonderful. Thank you so much.
Thanks for having me, guys. This is fun.
Yes, sir. We'll see you soon. All right. So, I mean, that makes a lot of sense, right? The capital follows the founder. They need to have a sense of magnetism. They need to be able to storytell, and that helps them attract talented people. We've certainly seen that here at FreightWaves under Craig. When I first got here, that was one of the big things that attracted me to come and work at FreightWaves, was all of the really smart people in every division. Whether we had a PhD in data science or a CFA on the accounting team, there was just a lot of really, really smart people. Yeah,
I agree. I mean, that's how I landed at FreightWaves. I saw Craig speak at a conference, and you could just tell he was on a mission and knew what he was doing.
That's right. Everybody, thanks so much for joining us. We got a fireside chat with Catherine Schifferle up, the founder of Work Truck Solutions. You guys stay tuned. It's going to be a good one. Thanks for joining us.